Good afternoon, everyone. Welcome to the 2025 Oppenheimer Virtual Tech Conference. I'm Ken Wong, software analyst. Very happy to have with us Jason Conley, EVP and CFO of Roper, also Zach Moxie, VP of IR at Roper. Welcome, guys. Thank you for joining.
Thanks, Ken.
Thanks for having us.
Great to see you.
Great to see you too. Jason, Zach, maybe first off, while I think some are familiar with Roper, there probably is a fresh set of eyes, especially from our tech software audience. Perhaps just give a quick overview of kind of what Roper does, and then we can move on from there.
Sure. I'll try to make it brief, but so Roper's a vertical, market software and technology compounder, and what I mean by that is we compound cash flow in the mid-teens sustainably over a long period of time. So we're kind of a N of one in the software space. We sometimes get compared to Constellation, but they have a completely different motion in terms of their decentralized capital deployment and low organic growth. And so speaking of that, we get to growth in two ways. One is through organic growth of our existing portfolio. So we own 29 businesses today that are leaders in their niche vertical markets. We choose small TAMs because of their protective nature, and with market leadership, that provides like multiple paths to grow, and a high right to win in terms of new solutions that we can cross-sell to our customers. So today we're sort of in the 6 to 7% range. We think our normal range, or kind of if you adjust for some items this year, we're sort of in the 7 to 7.5% organic growth, and that converts to around high single-digit cash flow. And really, the second part of that is we take all that cash through and we invest that into acquisitions. Same sort of profile that we just talked about, leaders in their niches, and we fund that with our, like I said, with our cash flow and a little bit of investment grade leverage, and we do that to buy the next vertical leader. So you get this continuous growth flywheel from there. And then, I think it's just a unique opportunity for investors to own businesses that they couldn't otherwise own in the public markets, right? These are sort of great businesses that were in private equity, and we create value based on our long-term investment horizon. And so, we have this proven track record of making businesses, buying at a reasonable price and then making them better over a long arc of time. And I think, the punchline today that we want to talk about today is we think we can do even better. We're in the early innings of improving our organic growth of the portfolio and capturing more value out of M&A.
Got it. Perfect. And Jason, I want to maybe touch on two of the things that you called out. So focus on vertical software. I guess one, why did you choose that particular pocket of software? There's obviously a lot of great opportunities in the software ecosystem, something like 200 plus public companies and 1,000 privates. And then what's Roper's special sauce to managing this portfolio? Why do you feel you guys can extract this excess value that perhaps wasn't being recognized either in a private setting or in PE?
Yeah, thanks. I mean, the reality is Roper's been focused on, niche markets and kind of verticalized specialized solutions way back, 20, 25 years ago. We got into vertical market software back in 2004 with our DAT acquisition. So, I mean, what we love about it is that we're stay close to our customer. We have customer intimacy, so we're really sticky long-term relationships that gives you the high gross retention. And then, obviously just really great business fundamentals that you can, the go-to-market's a little bit lower because it's a lot of it's cross-sell. You can continue to invest in product innovation. Today, like our application software businesses are in the sort of, mid-teens as a % of revenue. So you're still investing back in the business. You can still continue to grow. They have wonderful cash flow characteristics. So we love that. A lot of our businesses pay annually in advance. So that helps perpetuate the growth flywheel. So I think it's just that and there's a longer reason we got into software that has to do with, but just buying businesses that were better than what we own, but we sort of got into it that long ago. But it's helped us give pattern recognition on what defines a niche market, how it can't be disintermediated and disrupted, and just how protected it is. So we love all the things about vertical market software because of that. I mean, I think the secret sauce, it's like a little hokey, but I think it's a lot about structure and culture. And, on structure, we have these decentralized operations we think helps us. Like our speed coefficient is very, very, is a competitive advantage. We're typically competing with other small companies. So being able to be nimble and having that high accountability at the business unit level, we think really is powerful. And then when you complement that with the resources we bring to bear with the businesses and sort of this, we're here to support you. we pay you based on growth. So there's no there's no shenanigans in terms of them doing things that are sort of incentive based. And so we have this sort of culture of high trust and mutual respect. So I know that sounds hokey, but it really does work. And then, like I said, we bring a lot of resources to bear. We're continuing to bring new resources around generative AI. We're doing a lot around that to help our businesses win in that area. We help them with strategy, just best practice sharing around pricing or continuous improvement or product velocity. So this has been like a real pivot for us probably, I don't know, 3, 4, 5 years ago. Really started with getting better talent in place in our businesses, and then enabling that talent to succeed as presidents, and then as their direct reports. So, and then I think the other thing is that like it's just all harnessed through our group executive roles. So these are seasoned operators that maybe they would go be an operating partner in a private equity firm, but they don't want to sit there and just try to optimize for the exit. They don't want to just put the hammer down on their presidents on OpEx spend and just grind on them. They really want to think, we're going to own this thing forever. I want to create value. How can I help my presidents and their direct reports be the best that they can be? So that's sort of the punchline, I think, on our culture and secret sauce.
Got it. So it does sound like it's still enabling maybe a startup culture is maybe too aggressively worded, but you allow them to still be what made them successful, but just with the resources of a large corporation such as Roper.
Yeah, and I think our maturing leader businesses that we've acquired, we bring a ton of sort of maturity and again, doing it not in a sort of standard way, but just like what are the areas where that's got them to this point, but it can make them successful and going from like Successflash going from 50 to 100 is different than going from 100 to 200. So bringing just some disciplines around that where it makes sense, I think is like really powerful.
Got it. Got it. And earlier you touched on this transition from your current organic growth rate, say mid-singles plus, to something more aspirational. Can you give us a sense of kind of where you hope organic growth can settle? What are some changes, both operationally and just how you go about your acquisition strategy that you think will help facilitate this move?
Yeah, so I mean, and just to ground anybody on why we're doing this, I think historically Roper was able to they basically get 400 or 500 basis points of TSR through multiple re-rate. And we clearly think current environment we're maybe undervalued a bit, but we're not ever going to bank on it as a strategy that we're going to compound through multiple appreciation. So as we looked at how we're going to accomplish and just through cash flow growth, sort of mid to high teens free cash flow compounding, we said really we never really even asked our businesses to be ambitious. And these are very successful businesses, but we said just don't go backwards. Send us your cash, and we'll keep the flywheel going. So that was really the reason. And then, like as I mentioned before, it really started with just improving the talent. So around selection, engagement, and development, we've been really focused on that for half a decade now. We also align compensation. We've always been paid based on growth, but we now have instruments that allow the business, if they grow up above and beyond their kind of normal run rate, and you have to do that over a 3-year period to basically have a 3-year CAGR of organic EBITDA above and beyond their normal growth rate. They can have significant equity grants. We granted a day one, and then they vest in the 3rd year, and so that gets us like that can be like private equity type returns for these folks. And now really it's about like how do we make so now they've got we got the right people, we got the right incentives, how do we make them successful? And so that's where you'll start to see we have resources at the center now to help with continuous improvement. So we have a Roper enablement system that we're building out. One of our leaders at our Verathon business is now leading that function. We've hired a couple of people, and we're really trying to be like super pragmatic about which businesses are they ready for it? Do they need it? Are there other competing priorities? We don't want to get in their way too much. So we've got like 2 or 3 businesses that are going really deep on everything in continuous improvement. I mentioned before, we're doing a lot around pricing. So we've got a couple of businesses that are going through an engagement right now on pricing that we ultimately want to harness and expose that across the portfolio. Seeing a lot of just really interesting opportunities there. We just finished one with Deltec, and it's super encouraging in terms of what that could mean for their forward growth algorithm. And then just I think that so that's kind of where we're at in this. And so the point is like when we buy a company, we're trying to build sustainable processes and capabilities that compound over time. This isn't like PE where it's just like a one-time surge. And so having our home or forever home ownership as a competitive advantage is how we think about that, and that ultimately will be going from 7 to 7.5. We think there's an opportunity to go to high single digits, the higher end of high single digits with the portfolio prior to 2023, and then of course we're buying businesses that are growing a bit faster, so that'll just be additive to that.
Got it. And getting to that high single digits, I guess, is there a way to think about how far you can get to that goal with the existing portfolio versus how much will have to be supplemented by things that you guys bring onto the platform?
Yeah, I mean, I think that's what we really are, aspiring to have the sort of pre-2023, 2023 and before portfolio get to that high single digits, and then, the ProCares, the Subsplash, Transact, Central Reach, those would all be additive to that number.
Got it. Got it. Okay, that very very impressive. So now you touched on Central Reach, Subsplash. Would just love some kind of initial feedback. What drew you to those businesses? What have you seen so far in the early days
Yeah.
of having those under your wing?
Yeah, and just, I mean, I think our observation over the last 10 years is, we got the question from investors, and I think it was a very astute question: is why aren't you buying some of these businesses that other private equity firms? And I think we had this sort of we were in this period of buying stable businesses, but with it, the math doesn't pencil out that you're not buying as much cash flow if you don't take a little bit of sort of measured risk. And these businesses all have great gross retention, just like the other businesses we own. They're just a little early in their life cycle. So it's like, first turn PE, it's not fully optimized from a variety of aspects. And so we just think it's an opportunity for investors to realize more organic growth and really outstanding conversion to cash as we drive, that higher margin and higher EBITDA. We think it's going to be 30% or more versus like the 2018 to 2022 era. That's what we've underwritten, and that's how we're sort of tracking. And then just like on Central Reach, it kind of checks all those things off. In addition to being a great vertical market software business that we have pattern recognition around that. It's just a little bit earlier, but we understood the competitive landscape and sort of how it's being formed and how their position was in that. So, it's just a great business that has a lot of market tailwind. So just to ground level set, it's a leader in the autism services space. So it enables workflow and administration of what they call ABA therapy. So we got 200,000 professionals already using the solution, and it provides the care to individuals with on the spectrum or related disabilities. And so just from a market perspective, there's a lot of tailwinds there. There's a persistent gap in care between the demand and the supply side, and so we see that being playing out for at least the next 5 to 10 years. The ABA is a standard of care across the autism space, so that's super helpful. There's reimbursement coverage has been established, reimbursement coverage across states and on the commercial side for some period of time. Not a lot of, by the way, not a lot of impact on the OBBB in terms of what that does. Medicaid it addresses more adults than children, and obviously children are the biggest learner population, as that's where you can have the most impact on individuals. I think just lastly, what we've seen, and it's been phenomenal, is as the clinics get bigger and get more successful, they end up coming onto our solutions. That's one way. And then also, if our customers are buying others, then we're tending to win with the winners. So just a great business, and I can continue to go on about that. Subsplash too. It's just I think it's another example of buying first-term private equity. We've had a relationship with K1 now for probably 2 years, and they're definitely mid-market, and they go and they buy from founders. So we were able to buy this business that's an emerging leader, but certainly a proven leader within the church management software space, sort of leading with digital and giving, and then pulling the church management software through with that. And So today they're serving 20,000 faith-based organizations. There's a ton of tailwinds in terms of how engagement and giving are more value drivers within that space, higher growing than other parts of the space. This is again another example where we established good relationships with K1, but more importantly, really won the heart over of Tim Turner, who's the founder there, and so he's staying on with the business, and that was certainly a helpful to get that process through. We did that on a proprietary basis. Feel really good about what they're doing there, and then they have an AI kind of first strategy that will permeate through all of their solutions too. They bought a company called Pulpit AI about a year ago, and they're using that to then cascade to the rest of their portfolio.
Perfect. Uh, Maybe circling back on the organic growth, the acceleration. Like I think one of the biggest questions we get would be with this change in strategy, kind of what are the downside risks? I think recently you guys called out maybe some early execution dynamics with ProCare, which you have quickly course corrected. But would love to kind of hear from you guys. Maybe what are some of the potential hiccups? What are you guys maybe changing or adapting to make sure that you guys minimize those risks?
Yeah, yeah. Thanks for the question. Now, I'll kind of start with what we're doing, and then we can touch on ProCare. I think, yeah, as I mentioned a little earlier, what the diligence around the market, how the market behaves, I think is largely the same. We have pattern recognition around the niche and the vertical and the size of the market, whether it's going to be interesting enough for a major player to come in and spend the capital to get in there to develop a product and get distribution. So I think that's pretty much all the same. The only thing I would say is we're a lot better on market diligence now because we have these investment partners we brought in who came from the buy side, and they really just help challenge our outside advisors. They're very, very highly complementary, and I would just say have made us a lot smarter on thinking about markets. And then I'd say also what we've dialed in more is the forecasting, just much more sophisticated around tying our forecast to a value creation thesis that's going to have multiple levers to realize the growth potential. So we're not like single threaded on one thing. And we do a lot of stress testing of these levers, and we bounce it against what we'd have to believe to, if one of these doesn't work, what else has to index to offset that to mitigate that risk. So it's not complete risk mitigation, but it certainly limits the range of outcomes a lot more. And I would just say, lastly, we're much more aggressive now on people and process. Sometimes it's hard in diligence to get in there, but we're really making a point to get in and we have some diagnostics. Again, we have pattern recognition around just how management's responding to certain questions or how we perceive some of their systems and processes, how quickly they can get information back to us to know that, hey, when we kind of risk score that and we have countermeasures like on day one so that we can help supplement those resources where there may be some gaps. And so that's it on diligence. I think on execution, we built up functional expertise over the last year across PMO. I talked about that Roper enablement system. There's PMO capabilities in there. We've added, some really strong folks on finance and accounting and cyber. So really the goal is to do like a full court press in the first 100 days to assure the teams are focused on the most important value drivers, and we provide the resources where needed. And I'd say just on ProCare, we did not get into the people and process fast enough. I mean, you have to remember this was our first maturing leader. And so I think we got the strategy we got it right 100%. Like I feel better about that business today than I did a year ago in terms of like their right to win in that market is really strong. There's like one competitor it's okay, but they've actually had a third of their workforce laid off. So they tried to do this like, just crazy go-to-market motion, but they've had a lot of folks churn out because the product just isn't as good. So I think just in that time too, we were like straddling the old and new way of governance around being deferential to our company CEO, and she was a little unwilling to help, and that put us behind a little bit. So I think the good news is we've applied those processes now that we have for Transact and CentralReach and now Subsplash, and so they're all tracking Transact and CentralReach. Obviously, CentralReach is early, but they're off to a great start. We feel really good about their performance and trajectory.
Got it. Okay, perfect. And probably took me longer to get here than expected, but one common question across every company that's presented today is obviously macro. you guys are both extremely diverse, so arguably, a little more resilient, but then also, all sorts of potential macro risks that could surface across 29 businesses. So
Yeah.
like would love to just hear what you're seeing macro wise in terms of impacts on your businesses, things that maybe are a little more urgent that you're focusing on, and maybe where maybe things are overblown.
Yeah, I mean, I think we've tried to highlight it on our calls, like the big sort of lagging from an end market perspective has been our Deltec government, contracting space. Having said that, in the last call, and I think we're really excited about what the OBBB can do for the business because, first of all, we've had 2 years of somewhat malaise, so we know there's some pent up demand. And the second, the mix, both the volume that OBBB provides and then the mix of where it's going to go plays right into the strengths of Deltec GovCon because it's more cost plus contracts. It's going to defense where like tracking project accounting is like super important. It gets audited. It's not just for profitability tracking, it's for actual compliance reasons. So just feel good about that. It's just been like the question is like kind of when that's going to free up, but we know it's there and we know it's going to happen. DAT, the freight market it's been a very, very long freight recession. And we're obviously not one to one with that business, but we're tracking sort of mid singles right now, but that business is a double digit grower. So that's just been we're waiting. We've been bouncing on the bottom from a carrier perspective. Brokers have been fine too. So we've been kind of realizing more on price to get us to that mid singles. We think that we'll exit the year a little bit higher than that, and then if we get any cooperation from that market in terms of freight, then that'll do better. And then our foundry business is starting to rebound from a exceptional situation with the writers and actors strike. So that's been just challenged, but certainly trending in the right direction. We think it's going to have positive growth in the second half, and so that'll be good. And then I think just like healthcare generally has been strong. Our solutions are kind of on the right side of the equation, especially when you think about Strata. Managing costs in the hospital, super important. Insurance has been great. So that's a very uh, fairly insensitive business to the macro overall, both at Vertafore and iPipeline. Um, I'd say education's been pretty, it's been very good on the higher ed side. I think K through 12 has been a little softer with some of the noise going on where the money's going to actually ultimately transfer from the DOE to other avenues. So those are probably the two areas: Deltec GovCon, a little bit of K through 12, and then nothing worse at DAT, just nothing great right now.
Got it. And I guess on the freight market, it looks like you guys at least are somewhat validating comfort there. I saw a recent acquisition of Convoy. Not sure to what extent you can comment on that, but would love any early feedback in terms of maybe the intent, what you guys see as synergistic there.
Yeah, I mean, we're really excited about DAT. We talked about this a couple of years ago in terms of like that's a great platform for us to do more value-added acquisitions. We'd only done one in the first 20 years of ownership. And so we bought Trucker Tools about, whatever it is, 9 months ago, and then we acquired Alco last quarter, first quarter, and now Convoy. So it's basically taking DAT that used to be a hitching post, a Craigslist, literally like no transactions. It's just a way for parties to get together and figure out what they're going to do off the load board, right? It's just a way for them it's information sharing. They pay a subscription. It's super, it's a super great business, but how do we essentially turn this into a marketplace where transactions can happen? A carrier can get its financing that it needs for a load through Outgo. It can, brokers can now track carriers in the marketplace via the Trucker Tools solution. And now brokers, because I mean, this is like a really good time for us to do this Convoy acquisition because the brokers are really trying to figure out how to save, cut costs. And so you can do that through certain loads, or they can automatically match them for more simplistic loads. And that's Convoy brings that capability to a broker that they didn't have before. And just for background, Convoy was owned, it was its own brokerage. And that failed because you need neutrality in that. How could they sell a brokerage solutions to another broker? Like that doesn't work. And DAT is the ultimate Switzerland. So we're really excited about what this is going to mean for the business long term. There's obviously quite a bit of integration work that's going to go on, and but this just leaps us forward a lot, and it doesn't come at the expense of the load board. There's always going to be a need for both of those solutions within the spot marketplace.
Got it. Okay, perfect. Sounds super exciting. More to look forward to there. Uh, and then on the topic of M&A, you guys have consistently called out the 5 billion of capacity. Maybe just refresh us on kind of how ambitious you guys are looking to approach the market, kind of why you feel comfortable with the pipeline. Obviously, lots of puts and takes in the markets right now, but would love your view on how attractive the environment is.
Yeah, I mean it's been just a kind of a weird environment for the last couple of years, as you know, and so I think it's been interesting for us because we've had the opportunity to have proprietary looks in portfolios that other PE sponsors wouldn't have, and the reason for that is that we're not really like if we end up taking a peek at a deal and doing a few weeks of work and then saying no, it's not looked at as a failed process. Whereas if another sponsor does that, it kind of gets out into the market, and then that can kind of like junk it makes it's sour, it makes the asset sour in the minds of, so then it's like they can never sell it. So for
Yep.
us, it's like there's quite a bit of abundance. There's been a logjam for 3 years. We think it's going to emerge at the end of this year and maybe early next year, but right now it's really interesting for us because we're getting some unique looks. We have a couple of big ones right now that could it might happen, it might not, but it comes down to price too, of course, just being super disciplined around valuation and paying relative on a sliding scale of growth. That's always an important part of this. We also think that some interesting deals where um, you know a great business, but the AI opportunity is actually not as interesting. So it's not necessarily they're going to go out of. There's one business we look at is just super super sticky, and I don't see them getting displaced by AI. But we also know that they don't have any rights at all to even use the customer's data, even improve the product, because the nature of the end market is so risk averse. And so we said, well, that's not interesting at all. So like that's not going to be a growth catalyst. So we walked away from it. So it's just an interesting time as we look at deals where certainly our AI lens on both the opportunity and the risk is much higher than it used to be.
Would you say that AI lens has intensified over the last year and a half, or that could arguably be a deal breaker in some of these transactions now?
Um, Yeah, I mean, it's intensified in the right. I think we've always been looking for ways that a business can be disintermediated, and I think we've been obviously in the Gen AI flow of not knowledge flow and where it's going to be going for the last year and a half. So I wouldn't say it's intensified. Candidly, there's as you know, there just hasn't been many assets that have transacted. So it's like but we quickly can understand that maybe something's not going to be as attractive and try to because everybody puts Gen AI in their sales slides now, and then you got to click down, you got to pierce through like what the real substance of that is. But yeah, I'd say it's been on our radar for a year and a half to 2 years. I wouldn't say it's intensified, but we're probably getting smarter, if anything. Yeah.
Got it. Understood. And another question that comes up a lot on this particular topic, and it's obviously a very fluid market, but is a open IPO window, closed IPO window. I mean, should we view that as good, bad for Roper?
I'd say just sort of indifferent because most of what we're acquiring probably is too small to go public. I mean, especially if it's owned by PE. I mean, we've seen how that doesn't really work out too well. They have that overhang and it's kind of dead money. So Meridian Link finally got bought today. So that was, a Thoma Bravo business that had been out sort of languishing for a couple of years in the public market. So I just don't think it's especially in the sponsor world, like doing an IPO is very attractive, especially for the types of things that we would be interested in.
Got it. Okay, perfect. And this is kind of building on that prior topic, but I guess what is your kind of the Roper view on AI? How are you guys rolling that out across your various business units? And then obviously from your seat, Any thoughts on internal use cases? Like, how does that potentially translate to leverage for some of these businesses that you guys are looking at?
Yeah, I mean, I know it's like every company says this, so it's like you have to take everybody goes, yeah, sure, I don't believe you, but
We're
I
all
really,
AI winners, and
we're all going to be winners, right? So, and then certainly, obviously, across our portfolio, there's some that are more at risk. We've talked about Foundry than others that have a tremendous opportunity, like Deltek. Luckily, Foundry is like orders of magnitude smaller than Deltek, so we feel good about that, but. We do think, I mean, we have all of our businesses right now going and looking through their value chain and how the value chain is going to change over time. And really, it just points to this like massive TAM expander for us if we can replace or augment labor with agents. So I think we're excited about the pace of innovation is picking up, the pace of learning is picking up across the organization. The AI mindset shift is happening. I mean, we're quite decentralized in our operations, and we provide. I talked about all these resources, but on this one, Neil is definitely leaning in much more, and I don't think the presidents are getting annoyed with it. Like he's sending stuff every Monday on like here's some thought leadership. Here's how you have to think about things. So we're not being prescriptive, but we're certainly providing a wealth of information that we get the benefit of sitting in our seat. We're spending a lot of time with venture capital. Like we went out to meet with Andreessen Horowitz, I don't know, a few weeks ago. We have a constant dialogue with them. We've had an MIT Learning Day for all of our presidents who went out to MIT and did a whole day through that. So I think we see a lot of opportunity of selling products separately, be it like Central Reach does that today. Aderant has their own solutions that are separate. Construct Connect has its own takeoff solution is separate, or like this halo effect monetization in other places. Like, now we'll put only AI features in the Deltek cloud. So these stubborn, government contractors are going to have to finally get off the on-prem solution and get to the cloud. So we'll have sort of like an accelerant of lift there, or even Aderant's, being able to cross-sell things that aren't AI today, but are going to be AI faster. So they're sort of tracking that. So, and then internally, I think when we're doing more of these like learning seminars, but Deltek, the CTO of Deltek did one a few weeks ago on productivity and some specific use cases using Claude Code. And, like they're going to have a product they were going to release in a year and a half that now looks like it's going to be first half next year, just because they've been able to, get the MVP out, iterate on it, like just continue to use the modern, kind of code development. I think the one area that we really are trying to figure out is how to refactor code and rewrite it. Like we've been using experiment with quite a few solutions out there, and I think we're positive that it's going to happen, but that's taking more time than we'd like. So that's a real important part, is getting everything into a modern code base and refactored. But yeah, we think, I mean, the way we're thinking about it right now, I think it's probably going to be a little bit half and half how this plays out. But Neil's instruction to the business, like take those productivity gains and devour it right back into the roadmap or wherever you think the investment needs to be to help accelerate growth. I think realistically, we'll probably see a little bit of margin expansion as well, because it'll be hard to do that all at once. But that's certainly what we're telling our businesses is, to the extent you are seeing productivity, like get after that roadmap faster than you normally would be able to.
Got it. And I realize I was negligent on seeing if there's questions from the audience. If anyone has a question, feel free to send it through the portal, or shoot me an email, ken.wong@opco.com. And I'm not sure if there is a raise hand function, but if there is, feel free to go about that route as well. And then while that gets sorted out, I guess one more thing I'll kind of ask you guys more on a near-term basis, as you kind of forge your path towards accelerating organic growth. And you talked about seeing and projecting an uptick in the second half. What are some of the factors that are going into that math? How much of that is mechanical? How much of that is execution on your end?
Yeah, I'd say most of it is mechanical. We have a little bit better setup for a comp in both our TEP segment to a lesser extent and our network segment. And the network's more for the second half, Q3 more for TEP. So I'd say it's mostly mechanical. We had good second quarter bookings that help support, I'd say, our second half versus anything else. Just when you take the first half in general and our first half bookings, that supports the second half. So yeah, it's mostly mechanical. I mean, I think DAT and Foundry will continue to get better. Some of that's mechanical, some of it's just getting like better growth too.
Got it. Perfect. And just do have one quick question that popped in as a clarification. I guess as you think about growth coming in to the extent that you end up on kind of above expectations, is there a situation where that upside trickles down to margins, or is that something better suited for reinvestment?
Well, I would say it's if we end up having higher growth, our standard sort of framework on incrementals is 45%. It's probably going to be more like 40 to 45%. I say that sort of in a pre-AI lens.
Yep.
With AI, it could be back to 45%. I'm not a perfect forecaster for 29 businesses, but that's sort of I think that's how we thematically think about it.
Got it. One other question here. You guys have you guys typically kind of again you talk about it in forever home terms, but again lots of unknowns with AI. I guess to the extent you guys determine something might be a little more at risk than maybe initially anticipated. I guess any thoughts on is there going to be a quicker hook for do you guys approach it with divestitures in mind? Like how do you think you go about troubleshooting one of those type of scenarios?
Yeah, I mean it's a good question. I think because then you get to this, is there even a market for it? Kind of dilemma. The only thing I could say is that our businesses in these niches can be really creative on ways to continue to capture value and not have like something go out overnight. And I'll give you this is like a prior portfolio example, but we used to own a business called Transcores in the toll and traffic space, and the cost of a RFID tag was going down with the ASICs, like Moore's law was definitely taking over that space, and we were able to sort of manage that cost decrease in a way that we still were able to eke out sort of low to mid single organic just on pricing, packaging, optimization, contract negotiation. So and then that we did that for 12 years. And so I think, it's like you can be industrious around this. You can continue um, to innovate in other ways. I think like a foundry's got multiple products. Like a foundry just comes to mind, but like we're still going to be indispensable for a long period of time. So my preference would probably be, again, it's so small, would be to ride that out and optimize value versus trying to do some sort of exit. And obviously it's decretive growth, but it's the right sort of. I think about it just from a pure MPV standpoint at that point.
Got it. Perfect. And then last question for me. Like I think the maybe the biggest concern for constant kind of free cash flow compounders is maybe you kind of run out of runway in terms of stuff to buy. I guess what's your view on that opportunity set? I think one of your you mentioned Constellation earlier. Granted, they were talking about it from a longer term time frame, but maybe that they were kind of exhausting some of the opportunity on the software side out there. Yeah, would love just your quick view on how that could play out.
Yeah. Well, the one thing that's true is that the market of opportunities is never constant. Like there's always new things coming in. I mean, there was a business that just got acquired a couple of weeks ago that we looked at, and a public company acquired it. And we never, I mean, this thing got to 100 million of EBITDA, and we didn't even know about it until about six months ago. So, and it was a founder-run business and everything. So, I always see this thing as being, as long as there's entrepreneurs out there and there's capitalism that will continue to see new deals. I just don't think that has never been. I've never lost a minute of sleep over that in the last 10 years. There was a point in time where I was a little concerned about it because some of this was like our filter was so narrow, like management had to convey and all these other things. But we've opened the TAM up, but also opened the opportunity up. So we just have more opportunities than we can ever execute on.
Got it. Perfect. And with that, I think we're right up on time, Jason. Again, thank you for participating, Zach. Really appreciate you taking the time out of your day as well. Hopefully, you guys have another kind of set of meetings that'll keep you busy. But best of luck to you, and appreciate the audience for dialing in.
Yes,
Okay.
thanks everyone, and thank
Thanks,
you.
Ken.
Bye, guys.
Bye.